Wells Fargo, of course, getting its boost. The stock massive in the movement, reporting better than expected earnings, 53 cents per share. The nation's fifth largest bank, also boosting its quarterly dividend by 10%. In a first on CNBC interview, we're breaking down the numbers with their CFO, Howard Atkins. Howard, tell us everything you know, my friend. We all want to know. What can you tell us not only about Wells Fargo's books, but also where we are in the cycle of write-downs in your view of the liability that exists in the banking system in general right now as a result of housing?
Well, thank you. It's great to be here. Obviously, we feel we had a very good quarter. All kinds of predictions about where we are in the credit cycle, and the shorter answer is nobody really knows. But perhaps more importantly, it is a cycle. At some point, credit will turn. We've indicated, at least in the real estate parts of our portfolio, losses will probably go up before they go down. But it is a cycle. It will eventually turn. The other part of that equation is that while the cycle will turn, if you can build the franchise of an organization, what happens is when the cycle does turn, you have a stronger company. And that's really what we've been trying to do. And I think the other important point is what's going on in the credit markets and housing itself. While people tend to focus on the negative of that in terms of higher charge-offs, and we indeed have had higher charge-offs, the flip side is there's a benefit to that. There are opportunities in the marketplace, and we've been enjoying those opportunities, and are probably one of the few banks that have been able to take advantage of the opportunities.
Walk us through some of those opportunities.
Well, so to take a couple of businesses, even in the mortgage business, we had $100 billion of mortgage applications in the second quarter. And our sense is that some of those applications, might have gone to other mortgage players that are not doing business anymore or who are struggling. We know that we are picking up mortgage producers, so that's one example. Another example might be in our asset management business. We're getting mutual fund inflows, in part because we don't really have in our mutual fund business any of the more complicated and higher risk products. So we're perceived to be a bit of a safety factor in the mutual fund complex. Assets of all kinds are being repriced relative to where they were 2 or 3 years ago, so spreads have widened out, and to the extent that you have the capital to take advantage of everything from middle market commercial lending to other forms of loans and securities, those assets represent good quality, long-term attractive yields. So those are the kinds of things that we've been doing, and that's really what's accounted for the growth in the franchise.
How good of a handle do you feel you have on the liabilities at Wells Fargo right now as a result of the housing situation and the credit cycle?
Well, we have a better handle on it perhaps than we did a year ago, but our sense is that in the housing market, conditions still remain, relatively soft. It's possible that losses, credit costs will go up for a period of time before they begin to turn. But there are some early indicators here that things may be a little bit better at some point. Even some of the public data, for example, the Case-Shiller index. A year ago, or at the start of the crisis, only had one of their 20 markets with housing prices improving. The more recent data show a larger number of markets, perhaps 7 or 8 markets of the 20, where housing prices have stabilized so much. So again, I don't want to necessarily use that as a prediction, but there are signs here of in the public, some of the public data indicating perhaps a little bit more stability.
Yeah, I mean, even if you just look at Wells Fargo's next few quarters, how confident do you feel in anticipating the financial performance of your bank?
Well, again, we don't provide guidance, and I don't really want to make a prediction about where things will be. What we're trying to do is mitigate risk on the portfolios that we're managing, and at the same time continue to take advantage of market opportunities to grow the organization. And that's really what we've been so successful doing so far.
Got it. Howard, a pleasure as always. Thank you very much. Howard Atkins, CFO, Wells Fargo.